Investment appraisal methods by Omar Ali Chowdhury. Intro. The two machines will be compared and analysed through different investment appraisal methods during the presentation. Such methods are vital tools through which both benefits and risks of each investment can be financially quantified. Using MPV, IRR, and payback period and ARR, I intend to undertake a comprehensive study to consider the economic feasibility of each alternative. The treatment thus arrived at will help Athletico Limited make an educated decision as to which machine is worth investing in. Payback period formula is often used by investors, consumers, and corporations to determine how long it will take the business to recover the initial expenses of an investment. Capital investment appraisal. A revenue increase has been witnessed for Athletico Limited in the last fiscal year, evidences in greater demand for their line of Athletico apparel. This upward trend might have been initiated by good marketing efforts coupled with an excellent brand image in the competitive apparel industry. Liquidity and solvency. In the short term, liquidity is measured through the current ratio, which essentially gauges current assets against current liabilities. The comfortable current ratio for Athletico Limited suggests an adequate balance among short-term assets and immediate liabilities. This liquidity stance assures the investor and indicates the company's solid financial health. Efficiency ratio. Low inventory turnover ratio for Athletico Limited denotes efficient inventory management. The company quickly sells an inventory and subsequently keeps holding costs and the risk of obsolescence at a minimum. Profitability and return on investment. ROE and ROA alongside Athletico Limited exhibit the efficient use of shareholders' equity and company assets for profit generation. The higher the ROE, the better returns shareholders get, making it an attractive investment for any new investor. These profit measures cover sustainable profits for the enterprise. Justification. Athletico Limited is in a pretty good financial position, which means it demonstrates a good deal of profitability, liquidity, and operating efficiency. Further, monitoring may help them contain costs and form strategies for expansion or diversification. Overall, a good picture is painted regarding the company's prospect. Through analysing machine 1 and machine 2, I have found out that through visualising the payback period, that the payback period is basically the length of time that it takes to recover the initial costs invested in a project through income generation of the project. Is the duration in which net cash inflows from the project cover the initial cash outflows. It is a measure of liquidity of the investment and also risk. While I compared machine 1 and machine 2, I found out that machine 1 has a payback period just over 3 years, meaning that the investor can recover money he has invested within 3 years. Machine 2 has a payback that is little less than 3 years, approximately 4 months shorter than machine 1. Therefore allowing the investor to recover his money almost 4 months earlier. And the highlight of this is a shorter payback period means faster recovery of the invested capital. Advantage of using payback period include things such as the payback period approach thus brings with it major benefits and considerations which can vary from being simple and quick. Quick decisions can be taken. It can be used as a liquidity indicator to help companies in determining time they will require to recover their investments. It is beneficial for firms that face budget restrictions. Shorter payback period projects are preferred where rapid technological developments occur to save any investments into an already out-of-date technological form. It also reduces the exposure to risk by taking into account those projects that can be recovered quickly. So it offers some operational flexibility. Disadvantage of using payback period include that it doesn't consider cash inflows or benefits, and projects with sizable future cash inflows and growth potential may be turned away on account of quick and small returns. Net present value represents the total value of an investment over its entire duration, adjusted to reflect its worth in today's terms through discounting. Advantages of Analysis of net present value is an exception among all of investment appraisal techniques and is very complex because of the time element it considers, while simpler methods ignore the time value of money. NPV discounts the expected cash flow using a discount rate of say 5%. In the analysis, an NPV would determine and compare various alternatives in terms of their financial feasibility. Advantages of NPV include it measures the total increase in the wealth of a company brought about by a project, thus making it a complete decision-making criterion. The method thus weighs the time and magnitude of the current and future cash inflows. Cash flows come in different times and amounts, therefore NPV discounts the actual future cash inflows to present value, thereby respecting their timing. It recognizes the time value of money at the outset, hence money in hand today is more valuable than the same amount in the future. Disadvantages of NPV: errors in estimates arising from forecasting residual cash flows or discount rates, and uncertainties surrounding these estimates can have huge impacts on NPV evaluation. Perhaps the investor prefers relative terms such as ratios or percentages in order to compare projects that are different in size and scope. The fact that it is absolute means it cannot be used for the comparison of different investments. Expressed in absolute terms, an NPV gives an expectation in terms of dollars that can be directly compared with the present value of all costs without providing a meaningful context for the investor. APR, the average rate of return. APR is a financial metric used to measure the profitability of an investment over expected life, expressed as a percentage of the initial investment. The accounting rate of return is such a tool which measures investment profitability. It looks at the average annual return